Markets soaring today as stocks hit fresh at record highs, but it was the move in bonds that was staggering. The yield on the 10-year seeing its biggest single-day jump since President Trump was elected back in 2016. The big move following back-and-forth reports that the U.S. and China plan to phase out some tariffs. So, what do you think? It felt like the equity side of the markets were a little bit skeptical of those headlines from the very beginning.
Again, the volatility in the bond market, if we saw half the volatility in the equity market that we see in the bond market, it would be headline news every day, 24/7. It's remarkable, these moves. I mean, the 10-year yield seemingly a couple weeks ago was 150. Now it's north of 190. That percentage-wise is incredible. I think volatility in the bond market of this magnitude is not a healthy sign. Equity market clearly sees something else. But I thought 180 sort of was a line in the sand for a reversal back lower. Now we're significantly above it. I think Dan's going to probably tell you something around 2.25%, and then is when the equity market starts to get worried.
Are you going to say something?
Yeah, I mean, listen, I'm just a dumb stock jockey, but I'll just tell you this, that the markets didn't love when rates were going lower this summer too much, and they're not going to love it if they go up too fast, too. I don't know what the number is, whether it's 2% was the breakdown in the 10-year Treasury yield that I think that people really wanted to see kind of hold early in the summer. So I just don't know. You know, with the stock market making new highs every day, if we see rates go up too quickly, I think that becomes a problem.
Isn't it a good sign that we've kind of held on in the equity side despite this big move?
I think so. I never understood I hope we have bad data so the Fed continues to cut so then the economy can improve. I'd rather just have the economy improve, which seems to be what's happening. So I think it's a good sign until it gets far higher than here, I think.
There's no question it's a good sign. And if you look back where we were even on October 3rd, the day we really kind of rallied the entire market, we've now gone almost 9% on the S&P in 25 sessions since then. Bond yields were kind of in the 150s or getting somewhere down near there. There's no question we were seeing a deflationary low-growth spiral, and that was part of it. But think about some of this has totally coincided with a Fed that has jacked up its balance sheet again. And again, I'm talking about stealth QE, which you can't deny is happening. We're over $4 trillion on the Fed's balance sheet. We've now cut 3 times in a row. Are we still reliant on the Fed here? But I think in the short run, that bond move was somewhat dependent upon what was going on in European yields. And if you look at bund yields and JGB yields, they're right now maybe more important. They are both up 70% off of their lows, and I think they are driving U.S. Treasuries.
All right. Well, the monster move into the bond market having some impact on the financials, and one top technician's doubling down on his bullish bank bet. Let's get to Chris Verrone, Strategas. He's over at the Plasmas to break it all down. Hey, Chris.
Hey, Mel. And listen, I think we have to start with what kicked off this entire move, and that's the uninversion of the yield curve. This is U.S. 2s and 10s, so 10-year yield minus 2-year yield. This is the low, -5 basis points on August 27th. I think the irony, late August, recession talk is pervasive. The PMI had just printed sub 50. That is when this move towards financials and cyclicality really began. So now we have a choice here. We have banks up 22% since late August. Are we going to take profit or are we going to press? And I think we press here. And I'm going to give you a couple names where there's more to go. Citigroup, obviously a bellwether. But let's just go back and think about the history here. This is a stock that doubled off the 16 lows. We then had a 40% drawdown over the last 2 years. It is just beginning to come out of this base. We got up through that key 73 level. I think the next near-term target's 86. I think longer term, this is a $100 name. Goldman Sachs, one of the brokers. Another name, it's had a bear market, down 47% over the last 2 years. Again, starting to bottom here, just broke out above that 222 level. I think tactically, 250 is the name there. And then lastly, and we almost feel dirty saying it because it's been such a bad stock for so long, but even the European banks quietly acting better. This is Deutsche Bank. I think we're near resolution. We've been this little wedge here for the last number of weeks. We think ultimately this one breaks out. The one number that I want to give you here, there are 30 analysts that cover DB. Only one of them has a buy on it. Extremely out of consensus. The chart is getting better. Its peers around the world are improving. The curve continues to steepen. Be long banks, double down.
All right, Chris, come on over. I mean, no question about Chris, right?
Can we just say something about Will, who's bringing the chair as Chris comes up? He cracked his head the other night, bleeding.
Bleeding into his
Stayed on the show. Staples in his head, and he's still here.
For real staples.
For real staples.
Players play hurt.
Ouch. All right, Deutsche Bank.
Yeah.
So do you think, so is it Deutsche Bank specifically, or does Commerzbank also have a light at the end of the tunnel?
Well, I think what's interesting, when you look at that part of the world, I'd even put Japan in this camp. All the dirtiest banks, right? The ones that have been terrible for 2 years, all turning here as well. Deutsche Bank can go 7 to 10. It's a 30% rally. Now, this was a $30 stock a few years ago, right? But these moves, I think, are just beginning. Look at the Japanese banks have all started to turn here as well. Unicredit also turning.
Garbage.
So this is a group move. And the garbage names tend to go up the most when that's the case.
So in a game of would you rather, would you choose U.S. banks or European banks?
I think ultimately we're people who play for duration and time horizon. Citigroup, JP Morgan, Bank of America are still best of breed charts. That is where we play structurally.
Okay. The move in the bond market also has implications on the dividend yielding stocks, and we've seen that play out a little bit. So what are you seeing in terms of where that trade goes? I mean, is the air gone from that trade?
I think what's so remarkable, bring your mind back to late summer. It was August, the recession talk was pervasive, the yield curve had just inverted, the PMI had just broken 50, and then all of a sudden you start to see this move towards cyclicality, right? So we had 13, 14 months of lower interest rates. There's a stimulative effect to that, and there's all different corners of the world that are starting to price that in right now, and that's at the expense of those very high PE utilities, staple stocks. I don't think those are done correcting. I think there's a move towards cyclicality. I think it's just beginning, and you want to use any weakness to get bigger there.
So this is, you're talking about the beginning of an overshoot to the upside, and you mentioned 85, I think, in terms of Citi, which I guess you can make an argument for, but are they going to just catch up to where JP Morgan is valuation-wise, or does JP Morgan sort of rise along with them?
I mean, I think what's notable when we talk about JPN, this is the only U.S. bank at an all-time high. It's the highest level it's ever been. It spent 2.5 years going nowhere. I think the message here is don't get too cute. These breakouts are 2 or 3 weeks old. Press them here.
All right, Chris, thank you.
Thank you.
Good to see you.
Good to see you.
Chris Verrone. What are you buying, European or U.S.
Well,
banks?
that's interesting. So if you want the European banks, look at that EUFN, which is a European bank ETF, which is basically only begun to fight. Again, as Chris pointed out, they have just started to run. And who is more levered to higher interest rates? The European banks have been destroyed by the ECB. They may have been bailed out, but they've also been destroyed. So I think that's interesting. And I would just say the rest of the world trade is also significantly outperforming the U.S. EM's outperformed by about 6.5%. The DAX in local terms or in dollar terms has outperformed by about 7% since October.
Are you feeling better about banks? I feel like since you feel better about retail names, maybe you also feel better about
Listen,
banks.
I said a few weeks ago, and I did it on Options Action. I said JP Morgan's breaking out, and you know, and just buy
JP
calls.
Morgan specifically.
And I know, but I've also been saying, like, listen, when you look at those technicals, take the name off of it, and you look at the environment, and you look at the market sentiment. Say yes, they should break out, and they should continue to go. I just don't, I can't put my finger on the fundamental drivers. I want to make one point on the TLT because this was one of my final trades last week. I actually think that rates probably see in the 10-year, they probably see some resistance at 2%. If you look at the chart of the TLT, it's been in this nice uptrend. It just literally bounced off of it today at 135. That was also the breakout level at July 31st. So to me, I think TLT looks like a decent setup if you think the rate run has kind of come to an end or see some resistance. And that is some cheap fall if you want to play it through options. There's a free OA for you right there.